The long run is here, and the models are wrong. One reason they are wrong is that they fail to account for the US provision of global reserve assets. Reserve status matters, and because demand for the dollar has been insatiable, it has been too strong for international flows to balance, even over 5 decades. More recent economic analyses allow for the possibility of persistent trade deficits that resist automatically rebalancing, and that's more in line with reality that the US has experienced. They show that by imposing tariffs against exporting countries, the US can improve economic outcomes, raise revenues, and impose huge losses for the tariff nation, even with full retaliation. In this sense, analysis of what economists call the incidence of tariffs indicates that a large share and burden of the tariffs are paid for by the country on which we are applying the tariffs. Countries that run large trade surpluses are pretty inflexible. They can't find other sources of demand to substitute for America's. Instead, they have no choice but to export, and America is the largest consumer market in the world. By contrast, America has plenty of substitution options. We can make stuff at home, or we can buy from countries that treat us well, treat us fairly, instead of from countries that take advantage of us. This difference in leverage means that other countries end up bearing the cost of tariffs. We can reallocate our demand across borders more easily than other countries can move their factories across borders. In 2018-2019, China bore the cost of President Trump's historic tariffs through a weaker currency, meaning their citizens became poorer, with less purchasing power on the global stage. The tariff revenue, paid for by China, was used to finance President Trump's tax cuts for American workers and firms.